Well, come back to the channel. Right now, a silent massacre is unfolding across every major United States brokerage. Margin calls are flooding thousands of accounts. Risk management algorithms are running cold. Mechanical calculations on leveraged silver positions, and the math is broken. In just 48 hours, silver violently crashed from over $75 to $69.53. Heavily leveraged accounts are submerged. Their equity has collapsed below maintenance thresholds. Brokers are not waiting for Monday. The notices are deploying tonight, deposit funds within 24 hours, or face total liquidation. But here is the anomaly that makes tonight historically lethal. The markets are frozen. COMEX is shut down. The United States stock market is closed for the holiday weekend. There is no regular trading until Monday, April 7th. Trapped traders cannot sell assets. They cannot hedge. They are paralyzed in an 89.5-hour blackout window. If they cannot manifest cash by Monday's opening bell, their positions will be executed blind. No negotiations, no limit orders. Total surrender to the gap open. To survive what is coming, you must understand the exact mechanics of a margin call cascade. This knowledge is the dividing line between the liquidated and the liquidator. A standard silver futures contract represents 5,000 ounces of silver. At $70 per ounce, that single contract holds a notional value of $350,000. But in the realm of leverage, you do not need $350,000 to control it. You only need the initial margin requirement, which currently sits at approximately $32,500 per contract. That is a leverage ratio of roughly 10.7 to 1. The maintenance margin, the absolute minimum equity you must hold to keep the position breathing, is roughly $25,000. Drop below that, and the liquidation sequence initiates. Let us look at the brutal math of the past 48 hours. A trader who bought one contract at $75 deposit $32,500. When silver collapsed to $69.53, they suffered a loss of $5.47 per ounce. Multiply that by 5,000 ounces, and you get $27,350 in evaporated capital. Their account equity plummeted from $32,500 down to $5,150. That is an 84% destruction of their margin deposit. The deficit is $19,850. Now, multiply this singular tragedy across thousands of contracts opened in the $73 to $76 range. Thousands of accounts, all facing the same 89.5-hour frozen window. When the opening bell rings on Monday, every failed margin call translates into simultaneous market sell orders. This concentrated burst of forced selling crushes the price even lower at the open, which instantly triggers margin calls on the next layer of accounts that were previously safe. A buyer at $72 might survive the initial drop. But if weekend gap risk pushes the Monday open to $67, that buyer is now $5 underwater. That equals $25,000 in losses. Another margin call, more forced selling. This is the cascade, a self-reinforcing Ouroboros of destruction that only stops when the leverage is entirely burned out of the system. We have witnessed this exact esoteric geometry of ruin before. In March of 1980, the Hunt brothers amassed an estimated 100 million ounces of silver through futures and physical hoarding. When silver began its descent from $50, their leverage became a gravitational trap. Their brokers issued a margin call of $100 million, an amount equivalent to approximately $380 million today. The Hunt brothers could not meet the call. Their liquid cash was exhausted. Their brokers executed the only protocol they know, ruthless, systematic liquidation. They sold the silver futures. They sold the corporate stocks posted as collateral. This forced liquidation of the largest silver position on the planet triggered a seismic shockwave, crushing prices and igniting margin calls on other massive entities. The cascade lasted for days. Silver disintegrated from $50 to under $11 in just 2 months. By 1982, it was at $5, a catastrophic 90% total decline. The mechanism that annihilated the Hunt brothers is identical to the algorithm executing tonight. Leverage moves against the holder. The broker demands liquidity. The holder fails. The broker liquidates. The scale and speed of modern telecommunications have evolved, but the fundamental architecture of the trap remains perfectly intact. The exchange did not watch this passively. They actively poured gasoline on the fire with a 50% margin hike implemented over a single week, raising the capital required to hold a single contract from $22,000 to $32,500. They weaponized the margin requirements, sparking the very liquidations we are seeing tonight. The danger of tonight is magnified by the geopolitical timeline. The non-farm payroll data dropped Friday morning, revealing an addition of 60,000 jobs. The dollar strengthened, fortifying the hawkish narrative and suppressing rate cut hopes. Traders absorbed this data while locked out of the closed American markets, but the brokerage risk algorithms never sleep. They recalculated the margin thresholds based on this data, pushing even more accounts into the liquidation zone. Furthermore, tonight and tomorrow, Asian markets in Tokyo, Shanghai, and Hong Kong open for trading. Any movement there bleeds into the electronic overnight systems. If silver bleeds $2 in Asia, the indicative price falls, and more automated margin calls deploy over the weekend. And looming over all of this is the Sunday deadline regarding Iran. In this 89.5-hour blackout window, any military escalation, any diplomatic fracture, any tariff retaliation will hit the Asian markets. If crude oil spikes on conflict headlines, the inflation narrative violently accelerates, the dollar surges, and silver's implied Monday opening price collapses further. When 9:30 a.m. Eastern strikes on Monday morning, all of this compressed kinetic energy will detonate in the first seconds of trading. If the price gaps down below $67, specifically breaking the $67.34 support, the cascade becomes systemic. Liquidity will vanish. Market makers will pull their bids. The price will enter a free fall until physical buyers finally step in. The price will find its floor around the $61 to $65 mark, where value seekers wait. The institutional entities who truly understand the esoteric mechanics of a margin cascade are not panicking tonight. They are preparing. They are positioning their buy orders in the electronic systems, waiting at the precise levels where they calculate the forced selling will exhaust itself. They understand that a liquidation cascade creates completely artificial prices. These prices are detached from fundamental supply and demand. They are the pure byproduct of leverage mechanics shattering. A margin call cascade is not a destruction of wealth. It is a wealth transfer mechanism. It forcibly rips assets from the hands of leveraged retail traders who cannot meet their margin calls and delivers them to the institutional cash buyers. The leveraged traders lose everything at the exact bottom. The cash buyers acquire the asset at a deep discount. And when the artificial pressure lifts and the price recovers to its fundamental value, they reap the profits. Every major crash follows this sacred geometry. The 1980 liquidation transferred millions of ounces of silver. The pandemic crash of 2020 transferred billions in equities. Tonight, the notices are out. On Monday, the liquidations will execute. The clock is running down its final 65 hours. The algorithms favor the mainstream illusion, and this is the financial education they do not want you to have. If you found value in this transmission, hit the like button to break the suppression. Share this with anyone who needs to prepare. Subscribe to Fault Line Finance channel to stay ahead of the next cascade. Do not get left in the dark.